Hey guys, welcome back. So in this video, we're going to be talking about market makers so that we can really understand the bid-ask price and what it means to us. So the bid-ask market makers, who are they? What is it? Well, the bid price is simply the highest price that a buyer for any specific security, whether this is an option, a stock, whatever, is willing to pay. So it represents the demand side for the market. For a seller, this is the price that they can expect to receive if you're selling an asset. So the bid price is how much people are offering to buy from you. Or as a buyer, the price you're going to have to pay if you want to get into your trade. As the ask price is the lowest price at which a seller is willing to sell to you. So it represents the supply side of the market for a security. And for a buyer, this price is the price they can expect to pay if they buy the security. So just something to note here, or actually let me read this one last section here. The spread, the difference between the bid and ask price is known as the spread. The narrower the spread price is, the more liquid a stock is. So, and the opposite is true. So when we're talking about, say, SPY, actually, I believe I have, SPY 499 call. You can see that the midpoint is 436 and the natural price is 437. There's not much difference between these two prices. It's a very, very tight spread, meaning it's a very, very efficient financial instrument. I say it's efficient because if the numbers were very, very wide, there might be leeway on either side of where we can move that little slider to try to make the deal better for us. But here, there's kind of nowhere to go to make the deal better. You get $1 or you lose $1, you spend a little bit more, but it's $1. On a company that has significantly lower volume, you might find the bid-ask spread, the bid-ask spread is 50, 100, couple $100 wide, making the deal vary drastically depending on who's doing the deal with you, who's sitting on the other end trying to get in or out of that trade. So you'll also find the same thing up here. This is buying stock, and you'll notice that SPY is very, very, very efficient. Like I said, this is one of the most heavily traded companies, assets, ETFs in the whole market. And as such, when you go to get a price on it, it's kind of set in stone. They know exactly what it's worth. Everybody out there is, haggling, but we're haggling over, like I said, $1. Not a very big difference. So definitely, definitely, definitely keep an eye on the size of the spread of absolutely everything you're looking to trade. And the tighter the spread is, just simply know it's going to be easier, so much easier to get in and out of your trade. The tighter, the better. So I recommend trading stuff with very large volume because you want to be able to get in and out of your trade for the best price. If you're trying to buy, you want to be able to buy for the best price. If you're trying to sell, you want to be able to sell for the best price. And when you're doing that, you don't want the number that you're looking to pay or sell at to be, to vary so greatly. When you're trying to sell at 437, 436, let's say this is a sell order. When you're trying to sell at 436 and the midpoint is, say, 405, well, you might have to go down from 436 to 415 to make the deal. Well, that's, you just lost yourself $19 per contract. That's not so fun, right? I mean, if it's $1 per contract, that you can handle that. But 19, just right here, 19 times 10, that's $190 that you'd be giving up on this trade. So that's not a very fun thing to have to do. The tighter the bid and ask, the better deal you're going to be able to make, okay? So who are market makers? Well, market makers are the firms or individuals who stand ready to buy and sell securities at all times. They provide liquidity to the market. They make sure the market remains efficient. So they provide both a quote for the bid and the ask price. So whereas you and me, we're retail traders, right? We're trading with the accounts that we have. But you're talking about these banks, these hedge funds, the financial institutions that control trillions, literally trillions of dollars. They have so much money that instead of just looking at things to buy and then taking profit and sell, they literally buy and sell at pretty much every single price across the whole board. Every single price. They are making sure that the market remains efficient. And they profit generally from the spread and commissions. So the spread, again, remember, they, depending on how wide that market is, especially inexperienced traders who don't understand the importance of the spread, who are willing to pay a little bit more or take a little bit less for each of their trades. Market makers are collecting profits from all of those traders who are not trading in the efficient side of the market. The inefficient side of the market is where market makers collect a bunch of extra income or a whole lot of profit from those traders through those inefficiencies. Now, by continuously buying and selling, by providing that mechanism, market makers also ensure that the markets stay liquid, that makes sure that you can get in and out of your trades. If the market maker was not there, if the market maker didn't have a bid price on and an ask price on every single financial instrument, option, bond, commodity, future, currency, stock, ETF, if they didn't have a bid and ask on every single one of those across the whole board on every company, every stock, then the market would not be efficient. We would all be wondering what the price is of something. Maybe SPY, I think SPY is worth 6,000. You might say it's worth 5,000. Maybe somebody else thinks it's worth 4,000. Who knows? And without the financial institution, really setting it into stone and always being there, they're ready to buy. I might say it's worth 6,000, but they're only offering 501 as of Friday's close. So I might ask for 6,000, but they've got a deal at 501 and they've got a deal at 501 and 1 penny. So that's the deal to be made. And they're sitting there ready to do that deal at all times because they have the cash to back it up and the order placed in case I'm ready to make the deal. So they're always waiting to make the deal, to make sure the market stays efficient. And they really trade all prices throughout the whole board. I really want to stress that. They manage their risk various ways. They hold stocks that are declining. They hold stocks that are rising against them that they might be short, and they employ sophisticated strategies and systems to manage all of these different risks. They sell options, they buy options, they sell shares, they buy more shares, they do whatever they have to do to continuously hedge their investment. And a lot of that hedging, the compensation of how they make up for it is profiting from the spread and profiting from commissions. Because keep in mind, every single option trade you make is going to cost you a commission. Every single contract that you buy and every single contract that you sell will cost you a commission. Maybe it's 50 cents, maybe it's less, but every time you get in and out, you are paying the market maker, paying the bank the right to get in and out of that trade. So that's really why you want to make sure you're only taking the best trades and you're not just paying the market maker to be trading, right? You only want to be trading when the odds of making money are high. You know exactly where price is going. You have a plan to lock in profit, and you know exactly when you'll close down the trade because you understand when it stops working. So only pay commissions when it's worth it. So who is the market maker to you? Well, the market maker is going to offer you the ability to buy and sell. They ensure that the deal can be made. They offer assets at the ask price, and they will buy from you at the bid price always. That's what the ask price means. That's what the bid price means, that there's somebody there waiting to fill your order. And who is that? The market maker. So the market makers are the ones that ensure markets remain efficient. They ensure that you can get in and out of your trades at all times. at the bid price, at the ask price, whatever they have established that number to be. So they set the prices for the market based on supply and demand. Investors do decide where prices are going. The more people who are trying to buy a particular asset, the more price will rise. The more people are trying to sell a particular asset, price will fall. And market makers recognize when these orders are coming in and will adjust the prices in the market appropriately to reflect that supply and demand. Now, to you, your broker is your market maker. They're the ones who make money for every trade you take in that commission. So it's really important, like I said, that you only pay to be in trades when you really suspect that it's worth it, not just to be trading, not just because price is moving fast and you're going to miss it, right? Price moves every single day. Some days it moves better than others, but the key is really to know which moves are yours. Not every move in the market is for you. And that's one thing I think most new traders really fail to understand. They see a stock moving, maybe a stock that they like, and they're like, oh, well, I like that stock. I need to buy it because I like that stock and I want to be in. I don't want to miss it. But that's not why you trade. You don't trade because you have a favorite company and you just want to buy some and see what happens, right? You trade because you want to make money. And the only time to do that is when you see something obvious happen. So you expect price is going to continue, you get in, price continues, you lock in the profit, stops continuing, you get out. That's it. You don't just get in because FOMO. And that's a big mistake a lot of new traders make. You have to recognize that market's always moving. Price on essentially every asset is always going up or down, maybe sideways, but there's always something maybe even about to happen. But it's not all for us. It's not all for you. It won't all fit into your strategy. And the real point of successful trading is to be able to wait for those setups that are obvious, that you know how to take action on, you know how to profit from, and that are predictable to you. Okay, so sometimes price moves without you, and that is okay. You should really only pay to be in trades when it's really obviously worth it. So there are a number of different types of orders we can do to get in and out of our trades. We can take market orders, also known as natural orders. We can use midpoint orders, or we can set the price for our order. So here I've just circled, I've got a limit order here. We have a natural price on this side, and we have a midpoint price on this side. Now, the market order or the natural order is the price that they want. That's what the seller is asking. Okay? So if you want to get it from them right this second, you pay the natural price. If you don't want to risk the option, the stock, whatever, increasing or decreasing in value and changing that number, causing you to have to pay more, then you're going to want to get in at the market or the natural price. This will allow you to get in immediately without any kind of hesitation. So these are used in highly liquid markets. So this is a great order on something like maybe SPY, where the option price is only $1 difference. If you're haggling over that $1, what does it really matter if you expect the option's going to go up $50, right? What's $1 against the 50 that you're going to make? Not so much. So if you really are trading something that's extremely liquid, that the bid and ask price are very tight, then maybe you want to do a market order to ensure you can get in that trade right this second and not miss your opportunity to enter. Sometimes price does move fast and you do want to get in right this second. Maybe the candle just closed. You think the next candle is going to continue really quickly. Absolutely does happen. Happened to me on Friday. I got into my trade. Literally within 1 or 2 minutes, I was already at my second target. And this is a trade I was in literally until the end of the day. It started at 10 in the morning and it went until 3:30, something like that. So, but like I said, I hit the first 2 targets within just 1 or 2 minutes. So sometimes price moves really, really fast, and when you have a really liquid stock, you might want to just get in right this second so you don't miss it because it's about to move and you know it's about to move. Price is breaking out, everything's lined up, all of your studies, and you have a strong expectation of what's going to go because it's on your scanner. Market internals look good, everything looks great, and that's what happened Friday. So it does happen. Sometimes you do want to do a market order because it gets you in without hesitation. Now, other times, you might be a little bit more calm. Sometimes price is moving a little bit slower, and you have time, the ability to get in at the midpoint. Maybe the difference between what they're asking is $5, and you can get in $3 or $4 lower. It starts to maybe matter a bit at that point. So you go for the midpoint order, you get in, or maybe you don't, and you have to adjust your price. This does happen with midpoint orders because you're negotiating. A midpoint order is one that you're negotiating with whoever you're trying to get to sell you or maybe buy from you to make a better deal. So the deal, if you want to make it now, is going to be that market or that natural price. That's the deal if you're ready to make the deal. But if you want to see if they'll come down to your price, you might want to do the midpoint order. I do midpoint orders a whole lot. I generally would say I prefer midpoint orders. But I do place market orders. It definitely does depend on how quickly price is moving and what I am trading. Like I said, if you're trading, say, SPY, where the difference is maybe only $1 and maybe price is moving really fast, market order on that highly liquid asset might be the better choice. Now, let's say you're in a stock, limit orders, or maybe you know what price you plan to buy at. You're waiting for it to fall to your price. Not typically the way I would think of a limit order because it just doesn't really align with my particular strategy. But more of I'm in a position, I'm holding on, and I see my target approaching. I have a pretty strong understanding of how my options are moving and at what price my option will be at by the time we hit my target. Maybe you set a limit order to sell the option you bought at $250. And when price hits $250 in the option, you're going to lock in that return. So you create a limit order with the price of, say, $250. And once price on that option hits $250, it will sell. So that's what a limit order is. And you might want to set a limit order, particularly when you're setting your profit targets. When you expect prices moving in your direction, you're trying to figure out, how much do I want to sell this at? I'm in the green, I'm getting ready to sell, we're almost to my target. Let's say the option's worth $242 right now, we're 10 cents away from my target. I think it'll be worth $250 by that number, and I gotta go use the bathroom. Maybe that's what it is. Maybe you just can't be in front of your screen, you don't have the next 5 minutes. It happens. When you're trading, life happens, whatever happens. Maybe somebody rings your door, maybe you're at work, your boss comes in, whatever the deal is. You might need to set a limit order so that you can just walk away from your monitor for a minute. And if it fills, then great, you made your profit and you came back and you had an order fill. That's generally how I would think about limit orders, is more of your walk away order for when you're setting profit. And there's another way I like to do these. We can get into it later, but it's really about setting orders at the price where our targets are. So instead of doing exactly a limit order, we set an order based on our targets, and then we can set it to the midpoint of whatever options are trading at that point. So I'll show you how to do that later on. But as for right now, just be thinking about market orders get you in immediately. Midpoint orders is where you negotiate the deal for whatever you're buying or selling. And a limit order is the price that you want to get in or out at. Okay? So also in this section, we want to talk about a few more key terms. I've already mentioned liquidity a number of times, but I just want to make sure that we really are grasping that concept. So liquidity in financial markets refers to how easily and quickly an asset can be bought or sold. So we want to trade things that are highly liquid so that we can get in and out of our trades very easily. When a stock is highly liquid, getting filled for a trade at market at that natural price is extremely easy because there's somebody there waiting. And really at the natural price, that's always the truth. However, the more liquid a stock is, you'll just notice that the orders get filled even faster. The more people are trading, you don't need to find the market maker to make the deal. There's somebody already there trading it, ready to make the deal. Although that's a market makers are always there to make the deal, but you will find that sometimes you do get filled easier, even at market on some assets versus others. SPY versus, I don't know, General Motors. I'm just thinking of something that I know is down and hasn't been highly traded this year. So, SPY is going to get you in and out a lot easier than something with lower volume, is all I'm trying to say. Market efficiency is a highly liquid market. Markets that are easy to enter and exit, that have very low trade times, is considered highly liquid. So it's typically a good idea to trade highly liquid assets because it ensures that you can get in and out of your trade with ease. And whenever we're looking to determine whether whatever we're trading is highly liquid or not, we should be looking at volume. Volume will tell you how many people are actually trading whatever you're looking to trade. So by observing the stock itself, you can determine whether there's enough average daily volume on that asset to expect good option volume, to expect to be able to get in and out, good liquidity on the stock. Typically, whenever I'm looking at the daily volume on a stock, on an asset, ETF, whatever, I want to see 5 million daily shares traded on average over, say, a 50-day average. So if you use the volume average indicator and you set it up to 50-day average, we want to see that the average 50-day volume is over 5 million. And honestly, 99% of the time, I like to trade stocks that have average daily volume over 10 million. I do trade some stocks that are over 5 million or under 10 million, I should say. But I absolutely, without question, prefer stocks that have an average daily volume over 10 million. These are the stocks that are going to have better option volume as well. Doesn't always have to be over 10 million for that to be the case. There are some exceptions, even on my watch list as of right now. But in general, it's an excellent rule of thumb. Over 5 million for sure. Over 10, absolutely better. But what we're looking for, especially when we're trading options, is the weekly options, the ones that are at the money, right in between, if you're looking in Thinkorswim, where it would be black or switch to blue on either side of the option chain, the ones right at the line. These options, we should be seeing hundreds, preferably we'll be seeing thousands of options traded every day on these at the money strikes. These are these stocks, the options I prefer to trade. If there's thousands being traded, then you're probably going to be able to find a buyer or find a seller to get in and out of your trade. And liquidity is really, really important for trading. Being able to find a buyer, find a seller is really, really important for all of your trades. You want to make sure you get in and out at the best price, and trading liquid assets is absolutely key to that. Now, here's what I was just talking about. This is the SPY options chain, and right here I've circled just kind of at the money. Really at the money, I would say 2 in, these two, and 2 out. And if you look at 2 in and 2 out, so this is 1, 2 in, 1, 2 out. So these 4 really right here, hundreds of thousands are traded. Hundreds of thousands. And if you look at the other side, 2 out, 2 in. Again, 200,000, more than 200,000 really or so, not quite more, but almost 200,000 just on the 2 in and 2 out of the money. These are inside the blue is in the money, and the black is out of the money. These 2 in are highly traded, heavily traded. And if you look at the bid and ask price, they want 159, they're offering 158. They want 104, they're offering, they want 105, they're offering 104. This is only $1 difference. $1 difference. That's $7, but really, like I said, right at the money is what we're looking at. These are the most liquid options I typically recommend you trade. So over here, okay, there's a $4 difference. You meet them in the middle at 178, not such a bad deal. $1 difference, $1 difference, and you have a $7 difference. So this, when you see a difference like this, I took a picture after market close. That greater difference on a couple of those just might be simply due to the fact that the market was closed and the interest kind of fallen off since the market had closed. And at the close, maybe somebody canceled their order, making the order that was left open a little bit wider, spread a little bit wider. That can absolutely happen. But regardless, you'll notice that there's hundreds and hundreds of thousands of these traded and lots of volume with very tight bid and ask spreads. Okay? And here's Chipotle Mexican Grill. Chipotle only has, maybe a couple hundred here. Not even a couple hundred, or just barely a couple hundred here. And if you look at the difference, well, you could offer $2,630 for this option, but they want $2,950. That's $320 difference. That's a big difference. So if you have to make that deal, maybe you offer the midpoint, so it's 2780. Okay, I'm just bear with me if that's not right at the middle. You offer 2780, and then the midpoint offer changes because they're still at 2950. Now the midpoint is at 2830. Wait, you only wanted to pay 2630. Now you've gone up 200, and they're only coming down 120. Who's getting the good deal there? Sounds like they are. And this is why we don't want to trade stocks or assets that are very or that aren't liquid or not as liquid, because it makes it much more difficult to get in and out at fair market value. So right there, I was talking about being a buyer. Now let's say we did. Okay, we got in, we bought it at 28.30, and heck, price went up. Now our option is this one. We've rolled up. It really went in our favor. We made a good amount of money on this option. Now we want 3,800 to get out, but they're only offering 3,500. So we're trying to lock in our profit. And we say, okay, well, I'll meet you at 3,650. And the second you did that, the midpoint price went from 3,650 to somewhere between 3,650 and 3,500. So now you work your way down. Now you're going to be closer to the buy price because the mid price just changed. They're not buying. They don't want it. They still don't want it because they are offering 35 and you want 36.50. That's still 150 difference. Remember, SPY is only $1 on either side. When SPY, it's really easy. It's like, okay, it's $1. Here, it's $150 per contract. So you end up making the deal, and the deal's at 35.75. You wanted 39 or 38, and you went down 225. And to get in, you went up 100 and whatever. So you can really kind of picture where you start to lose, where the market makers collect their profit from that difference in the spread versus something like SPY, where you're talking about $1. Here we're talking about hundreds of dollars difference based on how much they might pay you or how much you might have to pay to get in. And on the outside of this trade, you might have lost $400 on a single contract in profit because you paid too much to get in and they didn't pay you as much as you wanted to get out, simply because there's not a lot of volume, not a lot of interest in this asset. So we really want to make sure we're only trading assets that have excellent liquidity so that we can avoid this issue. Now, when we're talking about trading and we're talking about expecting stock to rise or fall in the market or having expected lean for a particular asset, we refer to this as being either bullish or bearish. Bullish represents or tells us that we're expecting that a stock or an asset that we're looking at is going to rise in value. And bearish simply means that we're expecting the stock that or asset, ETF, wherever we're looking at will fall in value. So overall, it's said that the bulls are optimistic about future price and the bears are pessimistic. Bears expect price to fall, bulls expect price to rise, and they're always fighting each other. Keep in mind that For every buyer in the market, every time you buy something, somebody sold it to you. Every time you sell something, somebody bought it from you. So there's always a bull, there's always a bear for every single trade going on. And it's just really kind of a matter of who's stronger. So we often refer to certain times in the market as bull bear fights, particularly choppy times in the market, directionless times in the market, when we don't really have direction, is when we say that the bulls and the bears are fighting. And then eventually, either there's going to be more buyers or more sellers, and one of those will take over. If there's more buyers, then the price will start to go up. And if there's more sellers, price will start to go down. And we have these terms, bullish and bearish, to help us, discuss that. So a few other key terms to keep in mind as we're going through this course. We also might say going long. As a bull, as a buyer, you might say that you're going long. It means that you want to buy, or you're going to buy, or you did buy, because you expect price will go higher. Okay? On the opposite side of that, we might say that you're going short, or you're shorting an asset. This says that you expect price to go lower over a period of time. And there's a couple of different ways that you can do that. You can short, or you can short, meaning you can sell shares that you don't own. You can have the bank, actually I should say, sell shares that you don't own, and you'll tell the bank, don't worry, I'm going to buy them back when price falls, and then I'll give them back to you. Now, for example of SPY, you shorted SPY. You sold 100 shares of SPY at 500 because you expected that this week price was going to fall. And let's say this week price falls to 490. Well, then you would buy those shares back, give them back to the bank, and you would keep the difference in profit. So the $10 for 100 shares, right? Opposite, going long, you're buying the shares and you're selling them for a profit. Typically, more than just typically, definitely, really with your own money. Maybe you use margin, but when it comes to shorting, you're usually doing things with the bank's money, usually on margin as well. But it's you're taking their ownership and saying that, sell these shares for me and I'm going to buy them back for you and give them back. Going long, you typically will be, buying, you're using your own money, you're saying that I want to own this, and then you're going to sell it at some point later. Now, when we're getting into a long, or we're getting into a short, we're typically doing that because price is either breaking out or breaking down. So when price is breaking out, we say that it's moving up, it's breaking above a level that was previously known to be resistance, and now price is above that, we're breaking out, breaking out of that area. And now we expect price to go higher because we're breaking out. On the opposite, breaking down is when price breaks below a level known as support and starts to move lower. When we think price is going to continue lower, it's breaking support, we say that it's breaking down. Now, it's not uncommon after price breaks out or breaks down, it continues for a little bit, and then it comes back to test that level that was broken. So we call that a retest or a back test of a previous level of support or resistance. So it's not uncommon for price to go past that resistance or past that support, continue for a little bit, and then come back to retest, back test that level to ensure that price is going to hold on the other side before continuing further. Another thing we should talk about is diversification. So keep in mind, the S&P 500 is a diversified asset. It has investments, it has stocks from a number of different sectors, from financials, energy, consumer discretionary, information technology, semiconductors. So it's already a diversified ETF. But whenever you're choosing a list of stocks that you might want to invest in, so maybe you want to invest in SPY, but you also want to have a little basket of winners, maybe like Apple or Amazon, Google, some big names that generally perform very well. All three of those are different sectors. We had information technology, consumer discretionary, communication services. So whenever you're looking to come up with this basket of winners that you might want to invest in, it's important that they're in different sectors. You shouldn't be invested in, Apple, Microsoft, CRM, all of these companies that are kind of IBM. Maybe you want to be a little bit more diverse. You've got Apple and Microsoft, so maybe you want to throw in a Amazon because it's consumer discretionary versus just being in computers, right? So being diversified in your portfolio is definitely a wise thing to do. And when it comes to trading, having a diversified watch list ensures that you'll always kind of know where the money is going. You'll always have setups somewhere. So like I said earlier in the course, maybe one week information technology, or one day information technology is really outperforming all other sectors. And if you have a couple information technology or a single information like Apple on your watch list, you can probably get in on that sector that day. Perhaps Apple will be leading the way. But if all you have is Apple, Microsoft, Nvidia, AMD on your watch list, and all of the money is going into JP Morgan financials that day, so instead of saying JP Morgan, I should say financials that day, and you don't have a stock like maybe JP Morgan on your watch list or Bank of America, then that day might be nothing to you. There might be nothing really happening because you're not diversified. You don't have a diversified watch list to see that on that day, the money isn't going into tech, but instead it's going into the financial sector. So if you have at least one financial on your watch list, I really like JPM, for example. It allows you to kind of see certain times that the money might be going out of tech and into financials, or out of financials into tech. Same can be said for maybe energy, consumer discretionary, any of the sectors really. So whenever you're building a watch list, personally, my watch list is about 9 to 10 stocks, and I have all different sectors in it: consumer discretionary, information technology, financials, semiconductors, communication services, industrials. So all different, that's 7 different sectors. And then I also watch the S&P and the QQQ. So out of all of those, maybe the money is going more heavily into tech one day. Maybe it's more going into the broad market and not as much tech. And that's because it's going into industrials and financials. Absolutely does happen like that. So it's important to create a diversified watch list as much as a diversified portfolio. And earlier I mentioned going long, going short, how we might do that on margin. This is when you're borrowing money from your broker to either purchase or short an asset, and you use the investment as collateral. So margin trading can carry higher risk if you don't know what you're doing. If you're trading using margin, especially if you're new, I would recommend only being on the debit side, meaning only buy things with margin. Do not sell things with margin until you fully understand the risk, because selling with margin can carry really exponential losses, losses greater than what you think you're investing if you don't understand the risk. So just something to keep in mind. But having said that, I do like margin. Like using margin for a certain set of type of trades, particularly when I'm buying debit spreads, selling debit spreads, buying butterflies. So these are 3 strategies that I use margin for in my trading account. But I'm not against margin. I just want to exercise, or have you understand that you should exercise caution when using it, because it can carry greater risk if you don't know what you're doing. We're going to get into how to use it effectively, properly, towards the end of this course. But really, all of my favorite trades, also I should say, 95% of my favorite trades that I always take, I don't use margin. Margin is that's kind of true. I don't use credit. I don't collect credit using margin 95% of the time. Sometimes I do, but I also understand the risk and I understand how to keep that risk minimal. And I do that using vertical spreads. Like I said, we'll talk about that much later in the course. And one more key term here, we have market capitalization. This is just going to be the total market value of a company using all of their shares. So earlier in the course, I also mentioned, say, like Apple has over a true $2 trillion market capitalization. So that means that the value of all of its outstanding shares is more than $2 trillion. If they were to sell every single share, they could have $2 trillion more than in cash. So it's not really a feasible thing to do. The company would probably shut down. I don't know how that would all work, but I'm just simply saying that that's its total perceived value if you were to be able to do that. So yeah, that's it for this section. And in the next section, we're going to talk about stock and market fundamentals. All right, so I'll see you in that section.